Your insurer shows you an illustrated return of 3 to 4% per year. Then your policy matures and the payout is lower than you planned for. If you've ever wondered, wait, where did the returns go? The answer is usually hiding in two words: participating fund. And once you notice this pattern, the next question is obvious. What exactly is going on behind the scenes? In this video, you'll learn how participating funds actually work, what's guaranteed versus what's not, how to sanity check performance across insurers, and the exact questions to ask before you commit your money for 20 to 30 years. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. And my goal here is to help you understand this without the sales talk or even jargon. So let's make participating funds painfully clear so you can spot marketing numbers versus planning numbers in under 5 minutes. Firstly, what are participating funds and how does it work? A participating fund or a PAR fund is an investment pool run by the life insurer. When you buy a participating policy, part of your premiums are channeled into this fund. That money is pooled together with other policyholders' premiums and then invested over time. Insurers typically invest across different assets to balance risk and return. A significant portion is usually in government and corporate bonds, which are steadier and help cushion volatility. Another portion is in equities, which can lift returns but can also swing more in bad markets. So when markets are rough, your PAR fund performance can have negative years too. Here's the key point you can apply immediately. If your policy's value relies heavily on bonuses, then you are relying on the participating fund's long-term performance and the insurer's bonus decisions. Now that you know where the returns are really coming from, the next logical question is, what kinds of policies use participating funds? Participating policies generally show up in whole life plans, endowment plans, and even annuities. Whole life participating policies provides lifelong coverage and typically build cash value over time. That cash value may be accessible under certain conditions depending on the policy rules. Endowment participating policies combine protection and savings for a fixed term and pays you a lump sum at the end, including any bonuses accrued. Endowments can also be structured as retirement annuity style plans that pay out for a number of years once you reach retirement age. One practical tip here is to match the policy type to do the job you want it to do. So if you're trying to hit a specific date like your child starts uni in 20 years, the endowment structure matches that timeline better than a forever policy. If you're trying to leave something behind or want a lifelong protection, whole life plays a different role. Also, don't assume an insurer has just one participating fund. A single insurer can have multiple participating funds with different goals, so you want to know which fund your policy is actually tied to. And this is usually where people start feeling uneasy, because once you see the structure, you realize not everything is guaranteed. Participating policies give you guaranteed benefits and non-guaranteed benefits. Guaranteed returns are the fixed benefits the insurer promises regardless of the fund's actual returns, and they're outlined in your policy document. Think of this as a safety net portion of your plan. Non-guaranteed returns are typically bonuses or dividends that depend on the participating fund's performance and broader economic conditions. These can boost your maturity value or death benefit in good periods, but they can also be reduced or not paid in weak periods. This is why policy illustrations matter, but only if you read them correctly. Illustrations show scenarios, not promises, so you should treat them like a range of weather forecasts rather than a confirmed plan. Here's an actionable way to use this in your own financial planning. Build your must-have life goals on the guaranteed value and treat the non-guaranteed part as an upside. Because if the non-guaranteed portion disappoints at maturity, you can't exactly call the insurer and ask for more. So, if guarantees are not the full story, the next question becomes, how do we judge the fund's real-world performance? Well, I have been collecting and analyzing insurers' participating fund performance for a few years now and have been updating them yearly. I've included a link to the post in the description below, but here's a snapshot. The table shows annual returns by year and an average returns row across insurers like AIA, Great Eastern, HSBC Life, Manulife, Income, Prudential, Singlife, and Tokio Marine. Here's the important caveat before anyone turns this into a competition table. The data in the table is not equally available across all insurers across all years, and the simple average can be misleading. That's why I've also calculated the geometric mean returns, including the 3-year, 5-year, 10-year, and 15-year windows. This is practical because participating plans are long term, so 10-year and 15-year numbers usually tell a more relevant story than a single grade year. From the average returns table, Manulife is number 1, Prudential number 2, and Tokio Marine number 3. From the geometric mean table, the ordering shifts, with Prudential being first, AIA second, and Great Eastern third. And over the years, I've seen the geometric rankings change many times. Now, here's the most actionable insight for you. If you look at the longer term annualized fund performance, especially 10-year and 15-year windows, most insurers struggle to even meet the 3% illustrated rate consistently. So, what do insurers do if they are generating lower returns in certain years or higher returns on other years? They basically smooth out the returns. So, what this means is that in years that the returns exceed 3% or the 4.25% illustrated returns, they will not declare the whole thing as bonuses. They only declare a part of it. Then in years where bonuses are low, say below 3% or even negative, they use the returns from better performing years to declare bonuses to you, rather than declaring none at all. As a result, your bonuses are stable in a sense where even in market downs, you get some returns. And we have seen many policies mature with returns below 3% because of long-term performance, despite illustrating between 3 to 4.25% returns. Oh, and did I also forget to mention, I've also seen insurers with par fund performance that are above 4%, but their illustrated guaranteed and non-guaranteed returns are lower than insurers with par fund performance are performing way below than them. Why? Probably because of the expense ratios or even overheads that insurers have. So, what should you do with this as a normal person choosing a policy? You use performance tables to calibrate expectations, not to pick the winner. Compare across various insurers despite them having lower par fund returns because they might potentially give you higher guaranteed and non-guaranteed portions. You should also check performance over a window that matches your holding period. So 15 years is more relevant than 3 years if you're buying a 25-year endowment plan. And you should plan your life goals using guaranteed values first because those are what you can actually count on. But performance isn't the only silent factor affecting outcomes because costs matter too. So, a quick important detour on expense ratios. The total expense ratios is a key factor in participating funds. Total expense ratios represents the total cost of managing and operating the fund, including fund management fees, admin costs, and distribution costs. Distribution costs usually include things like commissions, marketing, and other expenses to sell and distribute the product. Higher distribution costs can raise the total expense ratios, which can reduce net returns and therefore affect bonuses. It's a bigger concern when a product summary says returns include only investment expenses, which may exclude major distribution costs, meaning actual returns could end up lower than what's displayed. So, your actionable move here is simple. Ask what costs are shown in the returns and whether these figures are net of the full total expense ratios. With all that in mind, let's wrap this up into something you can actually use. Participating funds can be useful, but only when you understand what drives the outcome. They involve premium allocation into an insurer managed investment pool with returns influenced by asset mix, market cycles, and risk management. Your policy's guaranteed benefits are the backbone, and non guaranteed bonuses are the part that can surprise you for better or worse. Past performance tables and geometric means are helpful for setting expectations, but they are not a promise and they are not a fair one number contest when data coverage differs. Total expense ratios and distribution costs matter because they can affect net returns, and sometimes disclosures can understate what's really being deducted. So, if you want a simple, actionable checklist from today's video, here it is. First, plan around the guaranteed values like they are the salary in your budget. Second, treat bonuses like a bonus. Third, sanity check long-term fund performance windows that match your holding period. And be wary of relying on illustrated 3% as if it's a guarantee. And if you want help applying this to your own policy, you don't have to figure it out alone. If you want to learn more about participating funds and PAR plans, you can speak with one of our financial advisors. I'll include the link in the description below. If you enjoyed this video, don't forget to like, share, and subscribe for more practical financial tips. Thanks for watching. I'll see you in the next video.